Okay, good afternoon, ladies and gentlemen. It's 3:05. Again, thank you for those of you who dialed in. You're in the right place, which is the webinar this afternoon, which, as you can see from the title, is called Alternative High Yields in UK Real Estate Investments. I'm delighted to also be having guest speakers from different parts of the globe. We've got Jan Gasper from Godwin Capital. She's the Business Development Executive. And we've got Reese Boyle from Global Residential, who's a managing partner within the business there. It's great to see a lot of familiar faces. There's also some new faces. For those of you who don't know me, again, my name is Richard Lowe. I'm the CEO of Turn-Keyinvestments, and I've been working in finance, developer finance, and international real estate investment for now the best part of 14 to 15 years. Now, just to give you a brief overview of what we'll be covering today, there's two parts really to the webinar, and they're two alternative real estate investments that both provide very attractive high yields. The first will be from Godwin Capital and the Godwin Group, which is a very experienced UK developer. And we're going to be sharing a little bit about what a loan note is, which is effectively an alternative form of developer financing and lending money to a developer. From Global Residential and Reese, we are going to be discussing about UK social housing, which is becoming far more mainstream and has really caught the attention of major institutional investors such as Goldman Sachs, Blackstone, Schroders, and so on. And we're going to share with you something that I think is not very well known in this part of the world, and something that, again, for somebody who is a low-risk style of investor but wants a very secure, steady, fixed income generating asset, hopefully it may be something that would be of interest for you. So that's the roadmap of what we'll be covering. At the end, we'll have a Q&A. And in the bottom right-hand corner, you should be able to see a chat box, and you can put your questions in there. You might want to hold on to putting the questions in until towards the end, in case we've covered it during the actual webinar itself. But if not, just put the question in there, and we'll address and answer those questions when we're at the end. So let me hand over to Jan, who is going to just go through a little bit more about Godwin Capital, and sharing a little bit about their background and track record. So over to you, Jan.
Thanks for the introduction, Richard. Yeah, thank you for everyone who's attended. Yeah, to give you a little bit background on Godwin Capital, my main aim in the business is to raise capital to fund land acquisitions and pay for land deposits for our end users. So if we can go to the next slide, I can give you a little bit more of an overview on the company as a whole. Okay, so Godwin Group, to give you a little bit of history, we've been operating since 2003, and we've been going, so that's been over 20 years now. And we've got a very good history track record with working with institutional investors, pension funds, and big brands like McDonald's, Starbucks, KFC, Burger King, and one of Europe's leading supermarket brands, Lidl and Aldi. So to give you a bit of an overview, the business has two distinct arms. We've got Godwin Development, and this is where you have your project managers, your advisory board, and your construction associates. And what they do is they look to oversee the projects, and they deliver them from start to finish. So they work very closely with the institutional investors and pension funds, and they basically deliver what is required for them. And then Godwin Capital, that's where I come in, and we are the fundraising arm of Godwin Group. So what we look to do is we look to raise capital for these end users, just to fund the very early stages, and to basically fund the land acquisitions and land deposits. But yeah, Godwin Group as an overall has a very diversified portfolio, and we mainly focus on three key assets. So just on the next slide. So the three main assets that we really focus on. So we've got the residential sector, and this focuses on opportunities in the private rental sector, the build to rent, within housing associations, assisted living, and within the suburban and rural. So yeah, the residential sector is particularly important. There's a lot of demand there. In the UK alone, a lot of individuals are opting into more rental properties rather than getting onto the property ladder. So there's a lot of demand there with regards to the residential sector, and it's expected to reach 75 billion alone in 2025. In the commercial sector, we focus on opportunities within supermarkets, roadside retail, and neighborhood centers. And the reason for this is because casual dining is declining, and more people are opting into more convenience and speed. So roadside drive-thrus are particularly very popular in the UK, and that's where you'll see your McDonald's, your KFC, your Burger King, your Starbucks. In the residential sector, in the industrial sector, we focus on trade centers, distribution, and warehousing. And currently, what we're looking to do is partner up with Amazon just to increase their distribution and warehousing spaces. So moving on to the next slide, I'll give you a little bit more of an example on the previous example sites that we've worked on. So we've got the Alexandra Park in Nottingham, which is a residential build. This comprises of 26 luxury homes. So yeah, feel free to have a Google at that. It's really, really beautiful at nighttime. And then we've got your Starbucks in Brampton Huntingdon. We've got your Lidl in Worcester, Birmingham, and we've also got McDonald's in Nottingham. So yeah, that's just the previous example of our previous pipeline. But we've got a lot in the pipeline currently that we're working on. And I'm sure Richard will be happy to share the project experience with you if requested. Okay, so yeah, why Godwin Capital? First of all, we are a reputable UK company. We've got a very simple strategy delivered by a highly experienced team. The directors and the associates that we work with individually have 40 years of experience under their belt. So when it comes to finding opportunities, we do our absolute due diligence. And we make sure that it's beneficial for ourselves and our end users. So yeah, we're not a third party. We do deliver our projects from start to finish. So anything that we start on, we know exactly from start, beginning to end, whereabouts in the cycle we are in. As well as that, we do have a very rigorous project selection. We're very selective in the projects we undertake. And as mentioned, we do our absolute due diligence before we proceed with that. So yeah, we do always have our end user lined up. Before we proceed with any projects, we make sure we have an exit strategy. And yeah, as mentioned, we've got very strong partnerships with some of the UK's leading brands, such as Aldi, Lidl, KFC, Burger King, Starbucks, amongst many more. But yeah, Richard's going to give you a little bit of an overview on how we go about raising capital. And yeah, he'll give you a little bit more on the loan notes.
Great. Thanks very much, Jan. And again, big thank you for getting up early on a Saturday morning. Jan's dialing in from Birmingham in the UK. So early start for Saturday for you. So thank you. So what is a UK developer loan note? Really, in simple terms, it's an alternative way for a developer to raise funding through individual investors. It's an alternative to going to traditional bank financing, but developers like Godwin will also look at other forms of financing. That might be through private equity, joint ventures, through family offices, and maybe even institutional fundraising as well. So this is just one other alternative they use to have additional financing to be able to leverage and grow their business. And really how it works is this, is if as an individual investor, you decide to participate in this opportunity, you invest some money, that money then goes into like a pot, And that pot is a cash reserve for the developer to then be able to quickly move and secure a site and have first to market advantage when they see an excellent opportunity and be able to snap it up before another developer does so. So by having the cash reserves, they can move quickly and secure a site. Then, of course, as a developer will do, they will seek the planning permission. And one of the things with Godwin is being a very experienced developer. They have very good relationships and understand within the areas that they're working in what's required from a planning permission application. And then obviously once the application is approved, they have their own project team to be able to build out the development. And they may exit either by selling off the asset, or sometimes it might be refinanced at some stage when they feel that it's the right time to bring in senior debt. But as Jan touched on, one of the things that Godwin does is before they even enter to buy a development, not only have they done rigorous due diligence to make sure it's a sound investment, but they've already got the exit lined up, whether that happens to be Amazon for a industrial warehouse, whether it's McDonald's for a F&B outlet. They have already got the exit lined up, which significantly reduces the risk. And I've worked doing developer financing for many years, and people do all sorts of due diligence, and I understand that, and I encourage it. But at the end of the day, with these investment structures, as long as the developer builds and delivers, there's really very little, if any, risk. The risk lies in a developer that's inexperienced, doesn't know how to manage their cash, maybe doesn't have the experience or the relationships of how to apply to the planning departments, and the project gets stuck in planning and never gets out of planning. And so by choosing a developer that's got a strong track record, that has consistently delivered, and in case with loan notes have never defaulted, is a big tick in the right box. And so that's why I'll only work with a developer that's got a very strong track record, because it significantly reduces the risk for investors coming in. So how does a loan note work? Effectively, with Godwin, it's a 2-year term with a minimum investment of £5,000 or $10,000. And you can choose during that 2-year term to have what we call biannual interest. That is interest that's paid twice a year or every 6 months. Or you can decide to defer the payments until the end of the 2 years and receive all of your interest as well as your capital back at the end of the 2 years. Now, if you decide to do the biannual option, you would receive 10% per annum. Over the course of 2 years, that would work out at 20%. If you decided to take a deferred interest option, you would receive 12% per annum, or at the end of the 2 years, a total of 24% returns. So when I speak with investors, a lot of investors like this structure because they have a fixed income product giving them a very attractive rate of return, with peace of mind that it's secured. And I'll come to that in just a moment. Now, I think most of the callers or people attending today are from Singapore. And if you have money in a fixed deposit here in Singapore, although there's very little, if any, risk, the first, I think, 50,000 or so is insured anyway, in case of a default on a bank side. But you're looking at about a 1% return. And inflation at the moment, if we take the collective CPI inflation, is around about 6.4%. So each year, by just keeping it in the bank or a fixed deposit, your actual money is eroding away. Whereas at least here, you're not just equaling, but you'd be surpassing the rate of inflation. So for a lot of people, if you've got money sitting around in a bank account and or a fixed deposit, then over a 2-year period, you could get a much better rate of return. Now, it is a secured loan, and it's secured by way of a first legal charge over the properties that the developer is using the funds for. And it's very similar in the structure of how a bank would take a first charge on a property if you decide to buy a house or an apartment and you wish to take a mortgage. You apply for a mortgage to the bank. They say, yes, we'll be happy to lend to you. However, we are going to take a first charge on your property in case you default on servicing your mortgage. And really, it's the same here. The security, though, comes by way of a first charge, and that first charge title deed is held by an independent security trustee, which is a regulated company, which is at arm's length from the developer. And typically, the security trustee will do a lot of due diligence on the developer before they will even agree to being a security trustee. They'll look at the board of directors, they'll look at the financials of the developer, they'll look at the track record, and make sure that it's a strong, steady, reputable company. But if in the very unlikely scenario there were a default, then that security trustee who holds the title deeds on behalf of the investors has the ability to step in, repossess the properties or the land sites or the developments, and effectively sell those off to recover the capital back to the investors. So they play a very important role and hopefully give you peace of mind that it's not just a loan and we hope that the developer will pay us back. Of course we do, but there is security as well to give you additional peace of mind. Now, if we took an example whereby you're investing £100,000, if we took the option where you take a 2-year biannual income, then effectively over a 2-year term, you are getting interest paid every 6 months, and effectively 10% on 100,000 every 6 months would be £5,000. And as we can see in the bottom left, at the end of the 2 years, you'll have accumulated £20,000 plus your capital of 100,000 back. If you took the 2-year deferred option, you don't receive the interest along the way, but you do get a higher rate of return at 12% per annum or 24% over the 2 years. And of course, that would equate then to £24,000 and your 100,000 capital back. So really, in summary, Godwin Capital and the Godwin Group are an extremely experienced developer. They've been developing property for over 20 years. They raise funding in a variety of ways, of which one is through these developer loan notes. We've mentioned that you have two options. One is a biannual interest return at 10% or a 2-year deferred return, which is at 12% per annum or 24% over the 2 years. And the minimum investment is £5,000, or you could do it in US dollars at a minimum of 10,000, or anything that you feel comfortable above that. And what I found again with investors, I speak with clients every single day, and I find that for clients that may have bought property, maybe they're accumulating quite a large portfolio, it's becoming quite challenging to manage that portfolio. Maybe they found challenging and quite an arduous mortgage application process. It can be challenging with all the AML checks that is required in the UK these days. So this is a very nice, it's not a labor intensive process. The application process, literally to fill out an application form, takes probably no more than 10-15 minutes with some supporting documents. That's then submitted to a compliance department and the security trustee. Typically within 48 hours or so, they will come back and let you know whether it's the application is accepted. And then once you transfer the money through, literally once the funds have landed, you start accruing interest from that very day. And typically I can turn an investment around within about 1 week. So it's very easy application process. You're not having to deal with tenants and having the challenges that sometimes comes with being a landlord, but you are getting a very attractive rate of return of between 10 to 12%. So for a certain profile of investor, it's, I think it's a really good addition to an overall investment portfolio. In times of volatility, where we've seen equity markets, really being very volatile at the moment, if somebody wants steady fixed income, again, it's a great option. And sometimes it may be for somebody who, just has some money sitting in accounts and it's really not getting a very good return. Again, maybe another option for you. So that ends the part on the UK developer loan note with Godwin Capital and Godwin Group. Now, what I'd like to do is hand over to Reese from Global Residential, who work in conjunction with Yield Invest. And Reese, if you can share with us a little bit more about Global Residential and what it is. Over
sure,
to you,
thank you,
Reese.
Richard. Thanks. Hi, everyone. Thank you for joining. So as Richard mentioned, I am one of the managing partners for Global Residential. I'm actually based here in the Middle East, but our team are predominantly based in the UK. We have 4 investment analysts who ideally look for the best UK property investments in the UK. And historically, that has been certain locations that we would really anticipate strong rental returns, but more importantly, high growth on that particular property. With Yield Invest, it's a sector that we've looked at for the last 12 months in terms of social housing, but we've decided to partner with a company called Yield Invest. So these guys are a developer, and through their own research with local housing authorities, they will identify properties that they can attach a social housing lease onto. So I'll give you a slight definition of what social housing is, as I think there might be a bit of a preconception for clients based overseas who might not be familiar with social housing. But for us in the current climate and clients looking for high income, this is a very secure sector in UK property. So I'll give a bit more detail as to what social housing is. And I think for any more questions, we can probably cover off at the end. But from our side, we are looking for the best asset classes in UK property, and social housing has been a great success purely due to the security and clients being able to access property as the underlying asset. So if we go on to the next slide, the question, what is social housing? So the technical term, sorry if I jump onto the next slide, Richard. The technical term is social housing is a highly regulated sector where operators are required to be registered with care providers and charities through the regulators. To invest in the sector, investors buy operating assets, i.e. physical property, where social housing providers have been set up to put a lease on that particular property. I think, Richard, it might be worthwhile you to try and define the difference between a government-backed scheme in Singapore, as I think the majority of clients joining the webinar today, there might be some slight confusion, but I don't know if you want to jump in here before I carry on with a couple more slides.
Sure. Yeah. Thanks, Reese. So for the callers from Singapore, and I think the majority are dialing from Singapore, we have HDB housing. And HDB is a government department that effectively provides affordable housing for Singaporeans to be able to get onto the housing ladder. And I think it's something like 89% home ownership, which is one of the highest anywhere in the world. And that's attributed partly because, well, first of all, property is very expensive here. So for many young people trying to get on the housing ladder, it can be a huge challenge if HDB, the Housing Development Board, didn't provide affordable housing. But not only do they provide affordable housing to Singaporeans, they also provide government grants to help with the initial deposits. You only need to put 5% deposit down in cash. The other 15% can be used with your CPF savings, which people, from the moment they start working, will start collecting CPF. So really, HDB is affordable housing to help Singaporeans get on the housing ladder. Social housing, although it is government linked, is not really for people to be buying the property. It is for people who unfortunately have come under hard times to give a roof over their head, whereby the government is actually paying the rent for these people that have fallen on hard times. And it could be somebody that has been out of work for a long time. It could be somebody who's a bankrupt. It could be somebody who's just gone through a divorce and is a single parent. It might be an asylum seeker. There are a variety of people that might qualify. But in effect, what it is the government is providing free housing to the less fortunate. So I think hopefully that clarifies the difference between what UK social housing is for and what Singapore HDB housing is. So back to you, Reece.
Correct, thank you. So if we jump on to the next slide, I can give a bit of an overview in terms of the demand for social housing. But again, just to kind of recap, there's basically UK funding that has been allocated in terms of a rent roll for the less fortunate. What we are basically structuring here is going to identify particular properties that suit the requirements for these housing providers and offering this to investors to physically buy that asset, and they would then receive rent roll from the government. But in terms of the sector, social housing actually makes up 20% of the residential property in the UK. However, there are 1.6 million people on the waiting list in the UK. It's actually 500,000 more than the 1.16, which has been recorded by the National Housing Federation. And the National Housing Federation have stated that there's a waiting list for nearly 2 decades for people to try and get social housing funding. In terms of the new product that's actually been brought to the market, and I'll give a slight overview in terms of the actual population who are actually in social housing. But as of last year, there were only 6,338 new social homes that were brought to the market. And that was a fall from of 84% since 2010. So even though the demand is significant, and I think even if we're looking at the UK real estate market as a whole, very much undersupplied in terms of demand, which has only been fueled off the back of the likes of coronavirus. So in terms of the security, the demand is most certainly there. And historically, this has been very much focused towards an institutional acquisition. But we're now really looking to try and fractionalize this and make it available for retail investors to gain access. So if we jump on to the next slide, this should hopefully give you a good summary as to what is available. So on the left, the key information that we are looking at, that we can secure fixed net returns ranging from 5 to 10%. And that would depend on what type of property you are buying, whether that's a single apartment unit or a freehold block. The investment sizes can range from £50,000 up to 10 million, again, depending on what you're actually acquiring. We are in relationship with Yield Invest with over 10 social housing providers, again, across the majority of the UK. And this is actually a typo on the left-hand side, but we've actually secured over 1,000 social housing homes and rehomed over 2,000 tenants. But in general, we're looking at an opportunity where rents are fixed on no break clause lease agreements on either 5, 10, 15 or 25 years. Typically, the longer the length of the lease, you would be looking at a larger portfolio, i.e. a freehold block in excess of £1 million. That might be a self-contained flat of, let's call it 10 to 15 units. I will give you some examples towards the end of this slide, or I think Rich can cover off. But essentially, we are looking to provide significant income with exceptionally low risk compared with other rentals that are affected by the wider economy. Again, if we are looking at any political uncertainty with a change in taxation, that can have an impact on certain private buy-to-let landlords. But I think the further that we progress through this presentation, hopefully you can get an understanding on exactly what is available for clients. So if we go on to the next slide.
Actually, Reece, would you mind if I just add a point, because I think it's quite timely with the point that you just made it. There you were saying rentals affected by the wider economy. Well, speaking with clients and obviously listening to the news, the general sentiment is the world could well be moving into a recession, and that always unnerves investors. And it's interesting asset class. If I compare some similarity with student accommodation, what we tend to find is that when the economy turns in a negative direction and goes into a recession, an unfortunate side effect of that is people do often lose their jobs. And what we've seen historically is when people lose their jobs, they very often go into education. And so we see enrollments in universities and higher education increase. So what we see in student accommodation is very much counter-cyclical to the economy, where student accommodation actually performs often better during times of recession. And the same really could be applied to social housing. It's unfortunate that when we go into a recession, more people lose their jobs, and it may be that they lose their homes as well, and they do need a roof over their head. And fortunately, the UK does have this social housing to help those people in need. And so what we see is that this can actually be a very strong performing asset class in times of a recession. So again, when you examine your overall investment portfolio, it's always good to have some asset allocation that is very resilient during a recession time. And this certainly has proved to be that. And one of the reasons why we're seeing so much institutional investment going in. So sorry to cut in there, Reece. I thought that was hopefully a valid point.
No, sure. I think, look, again, from our experience, we've always been focusing on private buy-to-let residential investment opportunities, which I think, again, there is an argument that even in a recession, if property values tend to fall, you'd like to think that there's going to be a significant demand on rental demand. But like you mentioned, if there is harder times for a private tenant, you could be considering rent defaults, missed payments or late payments, because the sector has been funded by the UK government, and more than £8 billion is allocated every single year just simply from the rent roll. Theoretically, you are renting an apartment or a block of flats or terraces to the government. So the security is very, very low risk. And if we do go back into kind of a recession, or it's hit slightly harder, that will only increase in terms of the UK taxpayer funding the sector. But yeah, I don't know if you wanted to cover this slide off, Richard, as I know that looking at the institutional buyer, it might be something that you want to cover off here if you want to touch on the next slide.
Yeah, and perhaps before I do that, again, just to give a little bit more context and clarity for those who are not familiar with social housing, we've been talking about the government being the tenants and social housing and people less fortunate. Well, how it all comes together is that central government basically has a budget for this, and they allocate funds to local government, who in turn allocate those funds to the approved housing associations. Now, the housing association in that part of the UK effectively is looking for suitable housing in line with what they require to put a roof over somebody who's come under unfortunate times. So they are the ones that are looking to find the properties, they manage the properties, and they are the ones that interview and screen the people to put into the properties. But the rent doesn't go to the person who's in the apartment or the home. The rent comes directly from the local government. Actually, could you just clarify that, Reece? Would the rent come from local government or the housing association directly to the owner of the property?
So the housing association basically collects funding from central government, and they would be appointed on the lease agreement with an investor. So for instance, if I bought a 3-bedroom house in Bradford, which I think is the example, on my lease agreement, I would be in contract with that housing provider. So they would draw down from the government. The housing provider would then pay that particular landlord. So again, they're the one who are managing the funds because they are overseeing bi-weekly checks on all of the tenants and making sure that the upkeep of the property is kept in check. So they will handle the funds and distribute on behalf of each investor and each property that they are in a lease agreement with.
Great. And on that note, actually, I was speaking to a client literally just yesterday, and he was wondering, well, will the tenants look after the property if they're giving it free of charge? Well, actually, in many respects, because they are getting free housing, if they don't look after it, they potentially can get kicked out. And so in many respects, as a tenant, they will probably look after it a lot better than, dare I say, a student might. So, you don't need to be concerned with the fact that, it may be somebody who's less affluent, they need a roof over their head, and they need to keep the apartment in good condition. And the housing associations, as Reece said, come in and do biannual checks to make sure everything is in good working order. So let's move on. Sorry, did you have anything else, Reece? Sorry.
No, I think, again, just in terms of the security. So if, for instance, there was any damage cover, and I think we might cover it off on the next couple of slides, but the housing association will be liable. So they're in agreement that if there is any damage to the property, they will have to replace, and it will be a fully insuring and repairing lease agreement. So again, even if we are looking or comparing it to the private rental market in the UK, if there is damage cover, okay, you have a security deposit in place from a tenant, but it's a lot more hands-free and a lot more low risk from an income perspective if there was any damage on the properties.
Great. Yeah, we'll go into that in a little bit more detail in just a moment. So, I mean, who is buying? Well, we've seen significant increase in institutional investment coming from the likes of Blackstone, Goldman Sachs, Schroders, where we see institutional investment in social housing rising from 1.5 billion in 2006 to over 10 billion in 2020. And you have to ask yourself the question, well, why is it these institutions are buying literally billions worth of social housing? Well, it's because they, on behalf of their investors, are looking for stable assets with good income generating potential. And, at the end of the day, the underlying asset is a property, which over the medium to long term is almost certainly going to go up. So it's a very, very secure, safe investment, where in this case, the rent and the landlords, the tenant is the government, and there are no void periods. So it really is a growing opportunity. The UK annual demand for social housing required by housing associations is estimated at 12.8 billion, which is actually equivalent to 145,000 houses per annum. So that's the actual demand per annum in social housing. And I'm just going to flick back to a few slides to see the contrast. If we look at the bottom bullet point here, only 6,338 new social homes were built last year, a fall of 84% since 2010, while social housing increased by 5% in the past 2 years, and that could well go up if the world goes into a recession. So there's this huge imbalance between the supply that's coming in. We know there's many people on the wait list, and basically it needs 12.8 billion of funding to be able to deliver the number of houses to try and catch up with the overall demand. We only need to go back 6 years and we can see that from a private equity perspective, zero funding, that's now increasing at 2.9 billion in 2019, and potentially people like yourselves may be funding properties that then can be used for social housing. And in many respects, it's an opportunity whereby not only can you look at a very secure investment, but you're actually helping a less fortunate person have a roof over their head. Now, what yield invest have done is basically take this asset class, and what was something that was traditionally only invested by institutional investors has now been made available for retail clients as well. So some of the main benefits. Yield Invest, first of all, have been doing this for 7 or 8 years. And as we can see, they built up with over 10 housing associations. They know how to choose the right property in the right location. They then renovate it in line with what the housing association requires for a property, so it qualifies, and then basically package it in a way that an investor could buy with a very secure investment. We mentioned, returns of anywhere between 5 to 10%. I think the average probably comes out at around about a 7% net yield, especially if it's an individual unit. Yield Invest, as I say, have been doing this 7 or 8 years and have really built up a very strong track record. There's a strong capital growth potential because the underlying asset is a property, and the UK market, when we look at the housing price index over a period of time, it goes upwards. There are a few blips here and there, but over the medium to long term, it goes upwards. There's full management systems in place. So the housing association is effectively your property management company. They will manage the property. They put and place the people in the property. They will do all the repairs and maintenance for you. And effectively, there are no void periods as well. And the other thing is that these are relatively inexpensive properties. We're talking potentially from as low as £50,000 upwards, which would hardly buy your front door here in Singapore. With these low cash ticket purchases, then they are cash purchases. So you don't need the hassle of going through a mortgage application, which can be, as I say, a very long and tedious process in the UK with all the AML checks. So some of the investment highlights: you've got an assured rent, as I say, typically around about a 7% net yield, free property and lettings management via the housing association. You've got a brand newly refurbished, renovated house. There's no ground rent or service charge. Now, for those of you not familiar with service charge, it's the equivalent of maintenance fees here in Singapore. All the repair and maintenance is taken care of. There's no void period. So as soon as the sale and purchase agreement is completed, literally the very next day, you would start accruing rent at whatever the agreed net rental is. So there are no void periods during the lease agreement. And those leases, as we've mentioned, are typically a minimum of a 5-year lease, very often then with an option to renew for a further 5 years. So Yield Invest feel that this is truly ethical investing because you are actually contributing to helping the less privileged have a roof over their head, and at the same time getting a very good return on your investment as well. So let's take a look at a typical unit. This is in Bradford, which is a city in the north of England. It's priced at £98,000 with a yield of a net yield, I should say, of 7.3%. It's a freehold property. And again, if we compare with Singapore, I mean, there is just no way that you'd be able to buy a 3-bedroom terraced property for £98,000. So for some of you, you might be lifting an eyebrow, wondering, my goodness, I didn't realize that outside of Singapore, and in this case in the UK, property prices can be so different. This property, if we look at some of the bullet points below, would be generating £7,200 per annum of guaranteed rent. And the last bullet point there, it says investment overview. So the property is being sold with a 5-year social housing lease in place. This means the buyer makes rental income from day one. No renovation works because it's already been fully renovated, and the tenant is found and placed for you. You don't have the hassle of having to manage your tenants and so on. And the property is sold with a performing investment as a performing investment property. So as soon as you've completed, you're going to get income, irrespective of whether the housing association has put somebody in there. It's the government that pays the rent from day one. And really, just to finish off, this property you can see is actually still very central in the city of Bradford. And again, to reinforce some of the key points, you're going to have a guaranteed rent. Your tenant damage is all covered, or the repair and maintenance. It's free property and lettings management. There's no void periods. It covers all utility bills, and you've got a 5-year lease with an option to extend for a further 5 years. So again, when I speak with clients, I feel that this kind of investment is ideal for somebody who is a very conservative investor. They're looking for a low-risk investment that is a good income-generating vehicle, and they're looking at a medium to long term of 5 years or more, with a lease in place with no void period. So I think it would be ideal for that kind of investor who's, as I say, looking again for a high-yielding fixed income asset. Now, there's one thing that we didn't mention, is that the rent is adjusted every year based on inflation. So one of the great things about these investments is that it's a great hedge against inflation. Now, data just came out, I think, a day or two ago, that the UK is now up to 10.1% inflation. And so if the average inflation for a 12-month period average at 10%, then your rent would go up 10%. And of course, that's going to start compounding over the years. So another great thing with this investment is that it's a great hedge against inflation, and the rent is adjusted every year in line with the average rate of inflation. So that covers off both of the investment opportunities, and I want to thank everybody for their time. I would like to encourage as many questions as we can manage in the time that we've got. There is a chat box, as I mentioned at the beginning, in the bottom right-hand corner. So if you have questions, please start putting those in. Now, just to help us so we know where to direct the questions, if it's a question to do with social housing, if you could just put SH in front of your question so we know it's steered towards social housing and REIS. And if it's to do with a loan note, if you can just put LN in front of your question, and we'll steer that towards Jan, and I'll try and moderate and jump in where I can as well. Now, I did prepare a few questions whilst people may be thinking about the questions to put in the chat box. So, Jan, if I can ask you, one of the most common questions I get when I speak about this asset class is, instead of paying such high interest rates to investors, why doesn't the developer go to the bank instead for a cheaper loan?
Yeah, thanks for that question, Richard. So we did used to do bank financing prior to 2016. So to give you a little bit of context, we did start in 2003, but we then started going down the loan note route in 2016. In 2016, our pipeline grew more so, and the relationships we had with end users also grew. So because we had a lot more demand, we require a little bit more speed and maneuverability. So as you know, we do have other competitors, other property developers that are also doing the same similar thing. So bank financing doesn't kind of restrict us. It takes around 6 to 8 months to get a loan approved. So in that instance, once the loan gets approved, it kind of gets snatched up by another property developer. So loan note has given us a little bit more speed, and the cash is readily available. So when we have a requirement by, let's say, Starbucks, who wants a new branch opening in Nottingham, we've already got that cash readily available, and all we need to do in our end what Godwin Developments, all they all need to do in that end is do the due diligence and make sure that the land is it's doable. So yeah, a lot of factors can come in. It might not be approved by the council board, but we always do our due diligence before that. So in that instance, the reason why we do bank financing is just to have that cash readily available.
Great. All right, lovely. So, I mean, in essence, having the cash gives you speed to market so that you can acquire the site, because if you went through bank financing at that early stage, it could take months to get approval, and late night somebody else has bought it.
Yeah,
so,
exactly.
Another question, Jan. How can a developer afford to pay such high rates of interest?
Yeah, so the way our business model is structured is that we always have the end user lined up. So the reason why we can actually afford to pay a high rate of interest is because the cost of borrowing is a lot lower than you think. So for example, a student accommodation, the gross development value of that could be 18 million. So we only use the investor funds in the very early stages to basically fund land acquisitions and pay for planning deposits. So once the land has been approved, the rest gets financed, forward funded by the end user. So reason being, the cost of borrowing is a lot lower.
Right. Okay. Great stuff. All right. Thanks, Jan. A couple of questions. I can see them flooding in now, which is great. Thanks very much for putting your questions into the chat box. But question for Reese. Did I wish to sell my property? Who can I sell the property? What are my exit options?
So theoretically, you are still the landlord owner, and like any typical buy-to-let property, you could buy a social housing unit today, and in a week, 2 weeks, 2 months, 5 years, whatever the time period or horizon might look like, you have the ability to sell at your own discretion. It can be sold on many property portals, i.e. Zoopla, Rightmove as an example. However, if you are still in a lease agreement, you must clearly state that there is a social housing tenant in place. So to take as an example, we look at, let's say, Bradford, the 3-bed terraced. That was on a 5-year no-break clause agreement. So if you are still within that 5-year period, you can sell to friend, family, or a new buyer through your own means of marketing, but it must state that it's as an investment opportunity throughout that duration of a period. We can also help resell the unit via global residential. Again, if you are holding it, let's say, past year 2, year 3, with inflation, assuming that we're looking at the rent roll to be increasing year on year, it can be remarketed at the same 7% net increase, given that that is your profit, where we can look at potential exit strategies. So you can dispose or resell that particular property, but depending on where you are within that lease would really dictate on the new buyer. If at the end of the 5-year lease agreement, you wanted to simply take that back and again be in full control of it, I move into that property or rent it out on the private rental market, you can do so. But I do really feel that, again, having a social housing tenant in place would offer great security and be lucrative for a new buyer. I think that's really where the benefit is. So hopefully that's answered your question in a roundabout way, that you have full control over that property. You can either come back through global residential to remarket and resell to a new investor, or you can choose to market and advertise it yourself in the open market.
Lovely, great, thanks, Reese. And I mean, we've been mentioning that it's a low-risk style of investment, but what are the risks investing in UK social housing?
I mean, it's difficult to say virtually zero, but I think if we're comparing it to, let's say, a completed property, look, we're buying into something that is newly renovated, and because the lease agreement is fully repairing, there is virtually zero risk, in my opinion. I think if we're comparing to the due diligence that a lot of institutional buyers would appraise when buying social housing, it would be on the actual social housing provider, how long and established they are. For instance, if we're looking at Mears or Serco as an example, I mean, Mears manage over 250,000 residential social housing units in the UK. So depending on the size of that outfit, that would be the only risk in my opinion. But again, having our own due diligence on the provider before we actually secure and buy that property. Apart from that, I do see very limited risk. And with the sector itself, i.e. social housing, it has been rated as triple star from Moody's, just to give you an example in terms of how secure the covenant strengths are on the lease. So I'd say there's very little, if any, risk in my opinion.
Okay, all right, thank you. Well, we've got quite a few questions coming in, as I said, in the chat box at the moment. I can see there's quite a lot around tax. So I'm going to kind of try to give a little bit of a generic answer for some of these, because first of all, tax is a regulated activity, and I'm not licensed, and I don't think Jan and Risa are licensed to give tax advice. I can give some high-level overview, and obviously tax differs from where you live and where you reside. So again, it's going to be rather challenging to cover that. But if you are, and I think the majority of people on the call today are residing here in Singapore, with a loan note here in Singapore, it doesn't attract interest. So you don't pay interest in the UK on the loan note interest returns that you make. Let me just go into Ken's some of his questions. Does the 2-year note have a fixed start and an end start, or it starts once the money is received? So Jan, maybe if you can help with that one.
Yeah, thanks, Ken, for the question. And yeah, so with regards to the 2-year note, it does start as soon as we receive the funds. So the application process, basically, we'll have to conduct an AML check before proceeding with the investment. And once we get the AML completed and you've sent over the funds, once it's been cleared on our end, that's when it starts from there. Great
stuff. And Ken's asking, are there any other fees on the amount invested? As far as I'm aware, there aren't any. So there's no entry fees or ongoing management fees. Is that correct, Jan?
Yeah, that's correct. So what you see is what you get. Whatever much you put in, you'll either get 10% or 12%. There are no hidden fees.
Right. Okay. Okay. All right. A question from David. Thanks for joining us today, David. What is the track record of Yield Invest? Returns from previous funds, transactions, years in operations, team track record. I don't know if you came in a little bit later, David. We did touch a little bit on that, but maybe Reese, can you just share a little bit more about Yield Invest and their track record?
Yeah, sure. So the two partners back in the UK, a guy called Nathan Smith and Frank Cartwright, they have the relationship simply with the social housing providers. So once they understand the local housing authority rates, i.e. how much a local council will be willing to pay for a 1, 2, 3 bed house or apartment, they will look to identify a particular property. They would then renovate it in terms of the requirements of that social housing provider and simply attach that lease into that property. So they have been established and operating in the sector for 7 pushing 8 years. So in terms of the track record, I mean, it's not necessarily see Yield Invest as a developer, a sourcing partner, going and identifying a particular property. Then once an investor has exchanged and completed on that property, you're then in contact with the social housing provider. So I'd probably say in terms of past performance, it would simply be about the increase and demand from the sector itself and how rents have increased year on year. Because it is quite a simple job from Yield Invest, just understanding local housing authority rates, going and securing a property, and transacting as if it would be in any other property transaction, be that residential, commercial, or industrial. So yeah, they've got enough experience in terms of actually renewing the leases when they come up for renewal, i.e. plus 5 years. But again, for more information on yield investing, those guys, I'm sure Richard or myself can actually send you a bit more information on yield invest.
Yeah, and Wilson had somewhat of a similar question. What is the role of yield invest, and is yield invest a sourcing agent? Well, hopefully that's cleared up, that in effect what they're doing is they are finding properties, they are renovating them. You could look at them like a developer, but they also have the relationships with the housing associations. They then package up these houses so that investors like yourself could potentially invest in a property and have a nice reoccurring income from that. Going back to the loan note, Jenny's asking, the projected yield is gross 10%. Well, they're not projected. This is a contractual agreement to pay 10% if you choose the 10% option, or a 12% if you take the 12% option. What is the net yield? Well, effectively, if you're a Singapore resident, you don't get taxed in the UK on these investment vehicles. But here in Singapore, you need to check with your tax advisor and whether you then declare that as a form of your income on a income tax. Okay, Joe, thank you for joining us. On the loan notes, US dollar investment would be denominated in US dollars throughout, i.e. would the interest and the reimbursement also be in US dollars? Maybe Jan, can you help us with that? If he invests in US dollars, let's say he does 10,000, does that make sense? Yep.
Yeah. So if he invests in 10,000, it's the question, will it be reimbursed in dollars again?
That, yes, and also will the interest be paid in US dollars?
Yeah, so yeah, that's right. So if the three currencies we accept is USD, euros, and pounds. So yeah, if they invest in dollars, the minimum is $10,000, and yeah, the interest they will receive will be 10% or 12% in dollar amount.
Okay, and then on loan notes, social housing, what is the withholding tax on interest and rental? Again, I have to flag up that we are not licensed to give tax advice, so we have to be very careful. And I appreciate it's an important topic, but again, because I live in Singapore for 20 odd years, I can give some insight. So, I mean, in the UK there isn't withholding tax, but if you have a residential property, then you are liable for income tax on a residential property for the income that's generated. You can apply for a non-resident landlord, and there's certain things that can be beneficial to that. But yes, it would attract income tax on a property rental.
I think I can probably just add a point on that. If you don't own any investments in the UK, you'll be starting on the lower rate of income tax, which for a non-UK passport or non-UK or EU passport holder, it would start at 20%. If you are a UK or EU passport holder, you will get a tax-free allowance. I think that's around £14,750. But there are ways to make it tax efficient by wrapping it into limited companies, etc. But I think depending on your circumstances, we can have that conversation, introduce you to a tax professional. But there are ways of making it tax efficient. But like Richard mentioned, it would be viewed as a simple residential property that you would be liable for income tax. Okay.
One for you, Jan, from Ying Z. Who pays for and selects the trustee? And then I'll just go on to complete the question. How do investors know that the trustee will do the necessary to recover the property and return the capital back to investors, assuming there was a default?
Yeah, so the securities trustee, they're called Blue Water Capital. They are regulated by the FCA. So for those of you that are not familiar with the FCA, they're basically the Financial Conduct Authority, which is one of the authorizing boards in the UK. I'm not sure what the equivalent is in Singapore, Richard.
It's the
but
MAS, so the
MAS,
Monetary Authority of Singapore is the equivalent.
So yeah, the equivalent of the FCA is the MAS, and so in order for them to operate, the security trustee will need to do their due diligence and make sure they go by the regulations of the FCA. So the question was, how do you know that the investors know that the trustee will do the necessary recovery? There is a mortgage debenture and a first legal charge, and there is a document on our portal to show that. Richard, being the introducer, he's got the legal documents for that. So for anyone who needs to request that in writing, you can do so just to see the title deeds. But yeah, they hold a mortgage debenture on our properties and fixed and floating charges on any cash in the bank. So yeah, it says it all in document. If we were to ever default, what would happen is they'll seize all of our assets to make sure that the investor gets to pay back their capital. Yeah, hopefully that answers the question.
Yeah, very good. Thank you. Okay, I'm conscious of time. I think the last question we've got at the moment is for Reese and from Joe again. Thank you. So, social housing, does it mean the property will come off social housing after the 5-year lease ends, or will the housing association normally continue with a new lease?
So I think, again, depending on the provider and depending on how long the lease agreement is in place, one provider that we're working pretty closely with is on a 5+5 year lease agreement. So basically that means that after the 5 years, it can be reviewed if you as the landlord and property owner wanted to terminate that contract, you would have the ability to do so. And likewise with the social housing provider. But given the amount of demand from social housing in local areas, if for whatever reason that particular social housing provider wasn't looking to extend, with Yield Invest, we could go and secure another social housing lease with in and around that area to apply a new lease on it. But the reason that it's been structured as a 5+5 year rolling agreement is that anything over 5 years, there would be a lot more contributions needed to be paid up front to stabilize that asset. Because again, in terms of the funding being paid towards HMRC and in terms of actually stabilizing the lease agreement, should that property be untenanted, i.e. a tenant not being in situ in that property, they would need to have a security of cash flow allocated to that property. We do also have providers that would look at 25-year no-break clause lease agreements. However, in terms of actually buying that physical asset and the contributions to get that lease in place, that would compress the yield, again, quite significantly. But for people looking at more security, because again, a 25-year no-break clause, fully repairing and linked to inflation lease, I think it would be good to maybe dig in a little bit deeper on a one-to-one call, or again, kind of asking Richard directly for any particular information on some of the options available.
Great. All right. Thanks, Reese. One for yourself, Jan. Again, I am conscious of time. So if you're happy to stay on the call, thank you very much. If you do need to go on because it's your weekend, then I understand. We won't take it personally. But for those of you who'd like to stay on, we've got a couple more questions that just came in. So for Jan, in the event of a default on the loan note, typically how long does it take for the investment to be, I assume, paid back? And how much per dollar is typically the case for the payback amount? I think just before you start, Jan, you haven't had a default scenario, so it's a little bit challenging to maybe answer that question because that hasn't occurred.
Yeah.
I've got a few thoughts. You share your answer, and I've got some things I would share as well, having done this for many years as well.
Okay. Like you mentioned, we haven't defaulted, and we've been operating on the loan note now for over 7 years. It's very difficult to answer that question. But with the security trustee holding the title deeds, what they would do if there was a default is them being the independent trustee, they would go to the court of the law and seize all of our assets. So they've got entitlement to all our cash in the bank, our properties, our land, everything that we owe. And typically, I would think that it would go to immediate effect if we were to ever default, because they are regulated by the FCA. So there's a lot of avenues that if we were to default, we would be in serious trouble. So, but yeah, like you mentioned, Richard, we haven't defaulted in 7 years, and we do pay the interest and the payments always on time.
Great. All right. Thank you. Last question for Reese. Will there be solicitor fees, stamp duty costs for purchasing social housing?
So a quick answer is yes. You are buying a physical property. So we do have a panel of solicitors who understand the lease covenants and kind of terminology that is in place. Typically, it's around about £1,000 for conveyancing costs, and there will be stamp duty. Again, we tend to look at the lower end in order to try and make that as tax efficient as possible. So again, just consider it buying a typical residential property in the UK that you have a lease agreement in place. We are in the process of setting up a social housing fund where a social housing product is the underlying asset for clients that want to try and make that a bit more efficient on entry and exit. However, again, the majority of clients when going out with social housing want to be in full control of that property. So it would be, again, you doing a typical conveyancing with a regulated solicitor. So stamp duty and taxes would apply.
Great. Okay, well, I see that the time here in Singapore is 4:17, so we have overrun, but there's some really good questions, and I appreciate your involvement, and thanking you again for your time on a Saturday afternoon, and for Jan, early Saturday morning, and middle of the day for Reese, or wherever you are in the world. Again, we really appreciate you joining us today. I will be obviously available for follow-up, whether that be a call or a face-to-face meeting if you're here in Singapore. I'd be delighted also to coordinate a Zoom call with Reese and Jan if you'd like to have a three-way call. So I hope today really has given you some insight to some alternative high-yielding UK investments that you may not have heard of before, and maybe food for thought in terms of how that sits with your overall investment portfolio. And again, we'll be delighted to follow up and have a chat with any of you who'd like to know more details, or if you'd like me to email you some more information, happy to do that as well. So I think we'll wrap things up for today. Again, thank you very, very much to all the guests and the speakers, and please do enjoy the rest of your weekend. Thank you and goodbye.
Thanks, Richard.
Thanks, Richard.
Thanks, Jan.
Thanks, everyone. Bye.
Thank you. Bye now. Bye.